afternoon. I would like to welcome you all to this public debate on how big banks fail, but more importantly also what to do about it. I won't say very much more. The floor is yours. I'm looking forward to your lecture.
One of the nicest introductions I've had. This is only one small slice of what we're looking at in terms of remaking financial markets. As you know, regulators and underlying that, Congresses, parliaments around the world are remaking financial markets in a number of ways to make them safer, more transparent, more competitive. And those are not inconsistent with each other. As Dirk said, one of the biggest open problems is the too big to fail problem. What do we mean by that? We mean that we have very large, complex financial institutions that we cannot afford to let fail currently, because if they did, the damage caused to the economy would be too great. Therefore, we must support them in their time of disaster. That's very expensive in the first place, and in the second instance, it encourages the same behavior in the future. This behavior is not necessarily unethical. It may simply be that creditors are happy to provide loans at low interest rates to these large financial institutions, knowing that they will get bailed out, and therefore these financial institutions have cheap financing, therefore they will go out and take on lots of risk. That is something we need to do about. I'm not even going to attack this slice of the problem in its entirety. I'm only going to go from the point of near insolvency to failure. So this is more technically oriented than simply the obvious, let's put more capital in the banks. What kinds of institutions are we talking about? We're not talking about the entire banking system. We're talking about the few largest institutions that are too big to fail. They tend to be complex. They're involved in many different lines of business. We can debate separately whether they should be in all of these businesses, but let's focus on the ones that are part of the liquidity crisis at the end. That's not typically commercial banking. It's not typically something like investment banking, underwriting, probably not merchant banking, but it does involve things like asset management, prime brokerage, proprietary trading, over-the-counter dealing, securities dealing, over-the-counter derivatives dealing, securities dealing, and the like. And on the liability side of the balance sheet, it involves most primarily repurchase agreements, which are short-term secured loans. I'm not going to try to go into all of these in great detail, but I'm going to try to show you some pictures to illustrate the action in some of these areas of banking that are most responsible for the final liquidity run. This is about liquidity runs. And if we can fix these, then we have time to have these institutions fail in a more graceful way so that we don't need to prevent them from failing and raising this moral hazard problem of bailing them out. Now, here are the steps to failure that frame our story. First step, the bank takes too much risk. After you've taken too much risk, there will come a day at which that risk will land in your lap and you've become not necessarily insolvent, but there become suspicions that you may be nearing insolvency. At some point, however, if you're not successful in stopping these suspicions, a run will begin. The run at one of these big banks is not like the run that you may have seen in photographs of the Depression or recently in Northern Rock, where you have depositors lined up in a long queue around the corner of the bank building. The run that occurs at these large dealer banks are with counterparties like derivatives, counterparties, short-term creditors, and clients. And when they run, they're going to take liquidity with them in a way that I will describe and further weaken your position to stay cash liquid. The last institution or counterparty to run is the end. That's your clearing bank. All of these large dealer banks can only process their capital markets transactions in the backbone of the capital markets through clearing accounts that they keep at other major clearing banks. And when those clearing banks decide that they cannot afford to take the risk to clear your trades because they might be caught in the middle of them, or they decide that they can only continue to clear if they get a large amount of additional collateral from you, then they have effectively run from you, and you will fail, because either you won't be able to supply the collateral, which is what happened in the case of Lehman, or they will stop providing clearing services, which is what JP Morgan eventually told Lehman, that's it, we will not clear because we're not getting the collateral. Once the clearing bank is unable to process your transactions, you're finished. So that basically makes it very clear who the last person out the door is going to be. It's going to be your clearing bank. Okay, here are the run accelerators that I'm going to spend the last few minutes on. First run. Prime brokerage clients are going to leave. What is a prime brokerage client? All of these dealer banks, or most of them, and particularly Bear Stearns, Lehman, Goldman Sachs, Morgan Stanley, and now JP Morgan, they have very large banking services provided to hedge funds. And I'm going to explain in a moment why, when those hedge funds become concerned about the bank's solvency, they will rush for the exits and further accelerate the failure of the bank. Second to run, or not second in time order, but the second on my list, the OTC derivatives counterparties. If they become concerned about the quality of your bank, they will try to move their derivatives positions to another bank. And when they do, they will take additional liquidity from you. I will explain that in a moment. Third to run, again, not necessarily in time order, although in this case it tends to happen at the last moment, are the short-term creditors. These are people that are lending you money overnight in what's known as the repo market. And they'll keep lending you money until they're a little bit concerned that you might not pay them back the next day. Usually overnight loans are very safe because how much could change in one day? But at some point, it's not so safe, and they're going to run, and you won't have any source of short-term liquidity. These large dealer banks, particularly the 4 or 5 that I mentioned before the financial crisis, were borrowing on a daily basis, each one of them, hundreds of billions of US dollars in overnight credit. A large fraction of their balance sheet, the liabilities, were obtained every day. And if they couldn't be obtained the next morning, you're out of business, unless you can get the Fed or the ECB to step in and provide the liquidity that's needed. And then, as I mentioned earlier, the last to run is your clearing bank. Okay, policy implications. This is my last list of things that I want to take you through. It'll take a minute or two. Okay, first, we need a new way to resolve these large financial institutions. One of the ways to do that is to set in place automatic triggers for recapitalization. We already have banking laws that say when a bank becomes undercapitalized, it must raise new equity capital. But we don't have any way to force regulators to force the banks to do that. So what we want to do is to build in automatic contractual triggers or regulatory triggers that have less discretion, that force the banks to recapitalize. And those are under heavy discussion in Europe in particular. My prediction is that in the US this is likely to fizzle, but that there's some hope for it in Europe. Improved segregation of client assets. I've already mentioned how important it is that when clients run, they're not taking liquidity with them. I mentioned a couple of instances. Lender of last resort facilities. It is important that when a bailout needs to happen, it does happen. The moral hazard is one thing, but if a large bank is about to fail, you need to provide liquidity. Central banks are built to do that. Effective clearing of OTC derivatives. I've already mentioned how important clearing is and that it doesn't work if it's not effective. Dedicated repo utilities. These tri-party repo banks are joined at the hip to major complex financial institutions that have multiple motives when dealing with those large banks. We need to remove the complications associated with that relationship and dedicate the repo activities to separate special financial utilities. And then finally, regulatory liquidity standards. These are now being worked out through the Basel Accords. And the predictions as to what they will say are fluctuating on a weekly basis. If you have any influence at all, and I'm sure some of you must, into the Basel Committee, please look carefully into seeing that these liquidity standards are tough, and that they force banks to keep cash set-asides for any of these liquidity-run losses that they may incur during the last weeks of their lives. Okay, so as I said, I would love to go into any of these topics in more detail. Perhaps we will in the Q&A. But for now, I just want to thank you very much for your attention. And I'm going to sit down right here, and I think Enrico is going to join me.